What's up, future Filipino CPAs? Let's jump right in. Today, we're breaking down a topic that is, no joke, the cornerstone of corporate accounting, the initial issuance of share capital. Seriously, if you want to ace the FAR paper and the LECPA, this is your starting line. Getting this right isn't just about passing, it's about understanding the very first page in a company's financial story.
So here's our game plan for today. We're going to kick things off with the big legal why behind everything, the capital trust fund. Then we'll make sure we're all speaking the same language with the core terminology. After that, we'll get into the nitty-gritty, the journal entries with the issuance playbook. Then we'll spice things up with non-cash deals, and finally, cover the stuff you absolutely need to watch out for, the red flags and real costs. You ready? Let's do this.
Okay, hold on. Before we even dream of debits and credits, we have to talk about the why. There's this massive legal idea that governs everything we're about to learn. And this isn't just some random accounting rule, okay? It's a legal pillar in the Philippines, and it's there to protect the whole business world.
I mean, it's a legit question, right? Why even have a minimum price? Why can't a startup just sell its shares for like a peso each to get some quick cash? Well, the answer really gets to the very soul of what it means to be a trustworthy corporation, and more importantly, how we protect the people who lend them money.
And boom, here it is, the trust fund doctrine. You have to burn this concept into your brain. It's a huge deal in our revised corporation code. It basically says that the cash a company gets from selling shares isn't just play money. Nope, it's a fund held in trust. It's a safety net to make sure that if the company goes under, there's money set aside to pay back its creditors, the suppliers, the banks, everyone. This doctrine is the why for every single rule we're going to cover.
So now that we get the why, let's make sure our vocab is on point. Knowing these terms isn't just good for the board exam, these are literally the Lego blocks you'll use to build the shareholders' equity section of any balance sheet. All right, in the Philippines, a company can issue two main flavors of shares, par value or no par value. Par value is just a face value, like a minimum price tag printed on the stock certificate. If it's no par, the board can just assign it a stated value. But here's the key takeaway, the study hack. Whether it's par or stated, that value represents the minimum legal capital. It's the amount the company promises to keep safe to back up that trust fund doctrine we just talked about.
I love this analogy. It's a perfect way to remember it. The par value is just the price of admission, the minimum legal requirement. But, if a company is hot and investors are hyped, they're going to pay way more than the minimum ticket price. And that extra cash they pay, it gets its own special name and its own account.
That extra is what we call share premium. You might also see it called additional paid-in capital, or APIC. Now, this is super important, so listen up. This is not profit. It doesn't go on the income statement. It's still capital from shareholders. We just park it in a separate account to keep things clear for legal and accounting purposes.
Okay, theory time is over. Let's get our hands dirty and actually look at the journal entries. These are the patterns you will see again and again, and you'll for sure need them for your exams.
Let's start with the most basic scenario possible. A company issues 10,000 shares. They have a P10 par value, and they sell them for exactly P10 per share. So, 10,000 times P10, that's P100,000 cash coming in the door. So how do we book that?
The journal entry is as easy as it gets. We debit cash for 100,000 pesos because our cash increased, and we credit ordinary share capital for the same amount to show our legal capital went up. Debit what you get, credit what you give up, in a sense. Easy peasy, right? Now for a scenario that's a lot more common in the real world. The company's got some hype, and investors are willing to pay more than the minimum. They issue the same 10,000 shares with that P10 par, but this time they sell them for P15 each. So what's the total cash? That's 10,000 times P15, which is P150,000. And here's where it all comes together. Look at this entry. We debit cash for the full 150,000 we received, but the credit side is split. Rule of thumb, the share capital account is always credited at par value. So that's 10,000 shares times P10 par, or P100,000. And the extra P5 per share, that goes straight to our share premium account. So 10,000 shares times that extra P5 gives us our P50,000 in share premium. Okay, we've totally mastered cash. But what happens when a company issues shares for something that isn't cash? Because it happens all the time. Sometimes they'll trade shares for a piece of equipment, a building, or even for professional services, like help from a lawyer. Here is another massive study hack for you. When you're dealing with a non-cash deal, there's a super simple two-step rule for figuring out the value. Priority 1, always
Always use the fair market value of what you got, the asset or the service. If for some reason you can't figure that out, then and only then do you use the fair value of the shares you gave. Just remember the order. What you get comes first.
Let's see that rule in action. So a startup gives 4,000 shares to its lawyers for helping them set up the company. The lawyer's invoice, the fair value of their work, is $56,000. So we debit legal expense for that full $56K. Then on the credit side, it's the exact same logic as before. We credit ordinary share capital at par, that's 4,000 shares times P10, so 40,000. The leftover amount, the P16,000, goes straight into share premium. See, the logic is identical. We just swapped out cash for legal expense.
All right, now we're moving into the part where accountants become like financial detectives. This is where accounting rules and the law really shake hands, covering situations where people try to bend the rules and how we handle the real costs of raising money.
Watered stock. The name sounds kind of weird, but it's a huge problem. This is when a company issues shares. Let's say they have a P10 par value, but they only get P7 worth of cash or assets for them. This is a big no-no in the Philippines. Why? Because it directly attacks the trust fund doctrine. It's like starting a company with a hole in its capital fund, which puts anyone who lends them money at major risk.
So who gets in trouble for this? The law is not playing around. Under the revised corporation code, the directors and officers who actually approved the sale of watered stock can be held personally responsible for that deficit, that water. They have to pay the difference out of their own pockets. It's a pretty powerful way to make sure they protect that trust fund.
Okay, but let's be real, raising capital isn't free. There are fees for lawyers, for SEC registration, for printing those fancy stock certificates, the list goes on. So a classic exam question is, how do you account for all these costs? Do you just expense them?
And here is another golden rule for your notes. Highlight this one. Share issuance costs are never an expense. They do not touch the income statement. Instead, we treat them as a direct deduction from the money we raised. The logic is, these costs reduce the net cash you got from investors, so they should reduce the capital you recorded. The correct journal entry is to debit the share premium account.
And this slide right here, this is your final boss review. You should probably screenshot this. If you can explain these 4 points cold, you've pretty much mastered the basics of share issuance. This is your cheat sheet for acing this part of the exam.
And let's end with a big picture question. It's something to think about. All these simple debits and credits you're learning, they're not just for an exam. They're part of a huge system that builds trust, that encourages people to invest. And that, ultimately, helps keep our entire national economy stable and strong. Something to keep in mind as you continue on your path to becoming a CPA. That's it for now. Study smart, guys.